Okay, in these next two videos, we're going to be looking at the share market and the impact that the global financial crisis had on the economy. Okay, so the first one, looking at the global financial crisis, um, clicking along, sorry. So I'm just going to summarize the key sort of things you need to be aware of. So first of all, the global financial crisis it started in 2007. So it started in the United States. So it began in the 2007 as a result of a large fall in house prices in the US. So up until 2007, the United States had rapidly increasing prices, and that was as a result of people buying houses relatively easily and people being able to get access to credit relatively easily, and people were buying houses knowing that they're likely to go up in value and they'd be able to make a capital gain, which is what you make when your house price increases in value. Banks were happy to lend out money, knowing that people would generally pay them back and they'd be able to earn interest on giving out that mortgage. Some people, however, wanted to borrow money even though they were at risk of not being able to pay it back. So people that didn't have stable incomes or a good track record of managing money felt that they could buy houses as well, and then they'd be able to see an increase in the value of their houses and they'd be able to make money as well. Interest rates were also really low, so it wasn't costing a lot to pay back, extra to pay back loans, which is also enticing people to borrow. So the banks continued to lend millions and millions of dollars to people, often to people who didn't have jobs or the money to pay it back. So these risky loans were called subprime loans, which is basically when you give someone money without performing the appropriate credit checks and finding out about whether they make enough income to pay it back. Often they were giving these loans to low-paid workers, to immigrants, often buying multiple properties, often with low-interest loans that would then increase as the loan throughout the life of the loan. And it's really important, this last bit here, that the banks didn't really care if people weren't paying their mortgages back because they were reselling these mortgages onto investors who invested in mortgage-backed securities. So the banks, rather than holding on to people's loans, which is what they generally do, and you're paying the banks back, they would sell the loans on to people who invested in mortgage-backed securities, and they essentially took value of the loan from the banks and essentially be paying them back instead. So what ended up happening is the banks lent way too much money to what we call subprime borrowers or risky borrowers. And the increase in borrowing caused house prices to increase astronomically from around the start of 2000 or 2007. But then eventually these subprime borrowers started to default on their loans and they had to sell off their houses. So in late 2007, after many years of increasing prices, this bubble began to burst. And many of the borrowers who were granted risky loans with interest rates that they could not repay in the long term started to default on their properties. So the banks took ownership of their houses, or in the case of the ones that they had sold on to those with mortgage-backed securities, they took ownership of the houses. Now, that wasn't a problem for the banks and these investors initially because they now had a house that was worth a lot of money when a small number of people were defaulting. But then when suddenly so many houses were brought up for sale, house prices started to fall. So supply exceeded demand. House prices started to plummet, and then what happened was the supply of housing, that increase in supply causes house prices to fall. Now many citizens who owned houses had negative equity in their houses, so their loans were more than what their house was worth. The people who invested in mortgage-backed securities had lost a lot of money because they had purchased essentially a property with, or basically given the money to purchase a property, and now this property wasn't worth as much. So what the banks decided to do is make it harder for people to borrow money because they knew they were in a tricky situation, and so many people were defaulting on their loans. And then because of that, it became spending decreased in the economy. So the banks lost millions of dollars because they'd lent way too much money out to people to buy houses. Those who um, had houses had a lot less money now because the value of their properties had gone down. The banks had lost money. People who invested in mortgage-backed securities had lost money. So many properties now were once worth millions of dollars were now only worth half as much. And as house prices started to drop, people would have, for example, $400,000 loans on properties worth $200,000. Many of these people stopped making repayments, and the supply of housing just went up and up and up. As house prices fell, citizens experienced a large decrease in their wealth. Some citizens became homeless because they couldn't be paid their repayments. And even those who could afford their repayments now had houses worth not nearly as much. So this led to a large drop in wealth, which led to a large drop in spending across the economy because people didn't want to spend as much as they weren't as wealthy. The banks were also becoming more reluctant to lend people money because they were fearful of people not being able to pay them back. So as spending started to fall from all these different sectors, businesses sold less products. There was a large decline in profits, which led to a stock market crash. So because companies made less profits, stock prices went down, and then people lost money in the stock market as well. So people had lost money in the stock market, their houses, investing in mortgage-backed securities, the banks had lost money. The only people that benefited were those people we discussed in the videos that bet against the housing market. So many Americans who invested in these shares lost millions of dollars on the share market, and that included a lot of retirees who had money in superannuation, which is very similar to what's happening at the moment with the coronavirus. Um, Other nations, including Australia, were also affected because the slowdown in the United States led to less export spending. So we didn't sell as much to overseas as well, or the US didn't want as many of our products. This reduced the amount of jobs in tourism and manufacturing. The share prices of a lot of Australian companies fell because of the lack of demand. So a lot less export spending, or a lot less spending on our exports, which slowed our economy down. But many Australians had also invested their money in the share market. So a lot of Australians lost a lot of money in superannuation and in shares, and spending slowed down in Australia as well as a result of all these ripple effects from the slowdown in the American economy. This led to higher rates of unemployment in Australia, and the government had to do two things. They cut interest rates to try and stimulate spending, and they also provided cash handouts to try and avoid a recession. So they gave people $900 each. And secondly, they for full-time workers that were earning less, I think it was 100 and something thousand, received $900 from the government. They also spent a lot of money on schools to try and avoid a recession. So that's basically the GFC. So to summarize, it started with the way too much borrowing in America. That was as a result mainly of banks lending out too much money because they were reselling the loans onto others. Too many people defaulted. House prices went down. People stopped spending because their wealth went down. People lost homes. Banks lost a lot of money, and that led to the share market crashing. And then that had ripple effects for spending in America, but also spending on Australia's exports, and also the people that had invested in shares in Australia as well.